It's that simple. The exorbitant fees you pay for actively managed mutual funds will literally cost you your retirement. Hello everyone, this is Anatoly with Simple Personal Finance. Mutual funds have been the primary investment option for millions of people around the world that are looking for some professional advice on how to manage their money and how to invest in the best possible stocks or in the best possible baskets of stocks, right? But the problem with these sorts of investments are the enormous fees that they carry, and sometimes the hidden fees that you don't even think about. The real cost of investing into mutual funds is often severely underestimated. This $13 trillion mutual fund industry has perfected the art of creating those products that sell well, that charge hefty fees, and often, honestly, they underperform their benchmarks. So just think for a second about an average person that has some money set aside, and he or she is thinking about starting to invest for retirement. What kind of options are available? It's probably either opening up a 401k account through your employer or going to your brokerage and asking your broker to manage your money for you. Actually, in both of these options, you're risking being lured into this wonderful world of enormous fees and underperformance. And if you just blindly follow the white rabbit into the wonderland, you're going to be taking advantage of 100% of the time. Let's start dissecting this problem little by little. We'll start with 401ks, the holy grail of American tax-effective retirement investing. Yeah, this $5.7 trillion industry is nothing more than a never-ending income stream for big financial institutions. Yes, it started with a benevolent intention of helping you save for retirement, saving your taxes, and your employers, they're helping you do that. They're providing all those generous match programs, right? But the unintentional side effect of this is that you're actually being taken for a ride by big financial players that have pledged to take care of your money, to take responsibility, and help manage your 401k account. The problem here lies within the fact that you are only given a very small number of funds where you can invest. And the fees that you're paying on the funds that you're investing to are ridiculous. So that's how it usually goes. Your employer engages with a financial services company to start a 401k program for its employees. Then you are given a choice of, let's say, 20 different funds where you can invest. And these funds are better be good, right? Because 401ks are a primary investment vehicle for most people who are looking to save for retirement. So you're expecting that this account and the contributions to this account are gonna make you enough money for you to retire comfortably. But sometimes 401ks are literally the graveyard of your retirement dreams. High fees, systematic underperformance are robbing you hundreds of thousands of dollars or even millions of dollars from your retirement. And since you're restricted to this one asset manager that your employer has decided to work with, you are locked in place. You cannot shop around for a better fund, for a better fee structure. You're literally stuck with this short list of funds that your asset manager provides to you. So you are in this take it or leave it situation where you're literally being cornered and forced into taking the tax advantage, but at the same time taking on higher fees and usually lower performance and lower returns. On top of stifled competition, managing 401k programs requires a lot of administrative costs, managing expenses paid to third-party administrators, and usually some or most of these costs get passed down to the employees, and you take the hit for taking advantage of this program. An average expense ratio on a 401k account is 0.45%. And you might think, so what? It's just the cost of doing business. I'm paying finance professionals for handling my money, for growing my assets. It's not a big price. I mean, maybe I should even tip them, right? Because I'm tipping my waiter 20% at the restaurant. And here, why wouldn't I tip my fancy financial advisor for doing a great job and bringing me some returns? But the problem here is that you're paying this fee no matter what. Whether they're bringing you money or they're losing you money, you're gonna pay their fee no matter what. And By doing that, they're siphoning off billions of dollars, and usually they're trailing their benchmarks and bringing you less return than you should have gotten. This constant underperformance gets so bad that on 16% of 401k accounts, the fees expense ratios are so high that they are literally negating all of the tax advantages and almost zeroing out even the employer contribution matches. But do you know what's great about this grand ripoff scheme? 37% of Americans believe that they don't pay anything on their 401k investments. And when big fund managers hear these numbers, they're probably dancing somewhere on their big fancy yachts. Alright, let's move away for a second from 401ks and focus on another traditional way of investing your money. Going to your broker. And when you do that, you're already stepping into the trap. The moment you go to open your brokerage account, you're already straight away you're being bombarded with their different marketing tactics of join our company, we'll help you manage money with our beautiful Morningstar 5-star rated mutual funds. Here are just some quick facts to shut this thought down once and for all. 96% of all active managers do not beat their benchmark over the 15-year time horizon. You heard it right, 96%. Just let it sink in your head for a second. When you're investing for retirement, you're investing over the long horizon, probably 20, 30, or even more years. So you are expecting to have very consistent returns that will make the power compounding work in your favor to really build that nest egg. And with this fact that 96% of fund managers underperform, why in the world would you ever want to invest in an actively managed fund? S&P 500 over the last 10 years on average returned 13.6% annually. An average mutual fund has returned a little bit more than 7%. Again, severe underperformance that's costing you 6% annually and probably hundreds of thousands of dollars over the long run of 15 to 20 years. An average all-in cost of investment into an actively managed mutual fund is 3.17% annually. Some of it includes some of the marketed fees like the expense ratio, but it also includes some of the byproducts of active management like cash drag or transaction costs. And no matter what happens, whether the markets are up or down, you're having a good day or bad day, they're gonna get 3.17% of your money. Yes, some of it is going into their pockets while some of it is being lost as transaction fees, but why should it matter for you? The fact for you is that you're losing 3.17% annually. An average lifespan of a mutual fund is just 9 years, which again just goes to show about the consistency of those funds, right? The big asset managers have to shut down their old underperforming funds and create the new shiny ones that they are selling under the premise that these funds will deliver exceptional returns. Is this the type of long-term investing you're looking for? Paying sky-high fees for subpar performance? This is just ridiculous if you ask me. Investing is getting the maximum amount of return for the amount of risk you take. And here, you're clearly being ripped off from both ends. You are not getting the return that you could have gotten elsewhere, and at the same time you're paying ridiculous fees that are killing you on the long run. And these fees, when they pile up, compounded over time, they have a huge detrimental effect on the earning power of your portfolio. Quick example to showcase what a devastating blow your portfolio can take from fees that pile up. It's even being called out on investor.gov website. So here is the hypothetical scenario. You invested $100,000 into a portfolio and you're holding it for 20 years. 3 different portfolios paying 1/4 percentage point, 1/2 percentage point, and 1 percentage point in fees. And you can clearly see that after 20 years of just holding for this investment, not adding more money to it, like you can see a portfolio that was paying only 0.25% annually in fees versus the portfolio that was paying 1%. There is almost $30,000 gap just right there. And the bigger the fee structure, the bigger your portfolio, the more money you add, the bigger this gap will grow. And in the long run, it will end up costing you hundreds of thousands of dollars, if not millions of dollars. But you might be wondering, why are you telling me all of this? If that's how the financial industry has operated for tens of years, well, maybe that's how things work. Maybe there is no other way how to pay less in fees and get better return. But the reason why mutual funds have been taking a lot of heat lately is because actually there is a more cost-effective way how to get better returns, more diversification, and pay less in those stupid hidden fees and suffer from chronic underperformance. And that's actually going to be the topic of my next video. I'll go in further detail and explain how to move away from this traditional type of thinking that the active mutual funds is the only way how to make money in the financial market. And I'll tell you my own personal story when I started digging deeper into my 401k account, and when I realized how much I'm paying in fees for the performance I'm getting. I was just sitting there with my jaw dropped, not believing that how blindsided I was. Thank you so much for watching. Please leave your comments down below, subscribe, and I will see you guys next week. Thank you. Bye-bye.